Hello everyone, welcome back to my channel. So this video marks the end of the week number 80 in this road to 100k realized return challenge. And yeah, another week, another huge volatility one. And apparently this time around, even though we had a lot of information coming out of companies, corporate earnings, the major focus was apparently on economic data that came out over the week, and that basically set the stage for a lot of volatility. Tech stocks were very heavily punished, despite they recouped somewhat some of the losses on Friday. But yeah, we have a lot to unpack here, so let's get down to it. Starting first, as usual, by our economic data. As I mentioned in the previous video, markets started the week going up. This ISM manufacturing came out good, much better than expected, and being above 50% means that there's an expansion. And quite interesting, I pulled up the news piece that talks about this. So as you can see here on the PR Newswire, and I got the time to read this article, and funnily enough, which is not fun at all, but if you look here at what the responders are saying, and let's see if I can find it, because yeah, what respondents are saying, it's funny, or rather odd, that if you make a search here for the tariff, you will see that in this case, respondents say that the impact of the latest tariffs on European Union will have a huge negative impact on our profit. We will not be able to recover the increased tariffs in our current quotations. Another round of emotionally charged tariff seems imminent, changing our landscape more. Trade tariff uncertainties creating volatility in the supply chain. So will now China to Mexico, which will now impose tariffs on parts made in China. This push for more Mexican supply chain, creating some more short-term supply management concerns. Confused and uninformed tariff policies continue to plague small companies, making long-term planning pointless. You cannot conduct business properly this way. Anyone who owns a business and who knows about business knows that you need to have some predictability in your business plans, and you cannot have that under such a uncertain environment. Business conditions remain soft as you continue to miss sales, orders, and profits as a result of increased costs from tariffs. There continues to be uncertainty and added costs through our global operations. Tariff impacts on our performance last year cannot be overstated, as we had a much smaller EBITDA. While other inflationary pressures continue to hit the business, tariffs and product costs played a large role. This year, we will continue our multi-country sourcing approach to manufacture and import products with more tariff-friendly currencies outside of China. So here, I think, yeah, the picture is very clear that pursuing these tariffs is absolutely non-business friendly, especially coming from a person who became US president on the claims that it will be great for business. Well, so much for it. And I also, let's jump here to because on Tuesday there's nothing here, there's some Fed speak, but it was not really that important. These auto sales, yeah, not that significant. Wednesday was a big day because of also the ADP employment, but first of all, the ISM service, I got the news piece also over here. Here, as you can see, there's PMI increased, which is of course good. Above 50 is expansion, and apparently accelerated. Not accelerated, but remained the same. But it was slightly up relative to the analysts' expectations. But still, if we look here, and I'm going to do the same exercise over here, the certainty of US tariff policies continue to affect our purchasing. Proliferation of AI is affecting how we purchase services. All right, data centers are causing large spike in requirements. Suppliers are challenging by capacity and tariffs. Overall, business is slow coming out of the end of the year and holidays. Yeah, so basically, these are much shorter responses, but still, um, even though there are, of course, we have also to highlight this. This is both an exciting and challenging time in the industry. Yeah, I can imagine it is. Um, solid holiday performance across most units. January is even better. Consumers are still buying the discretionary goods. So keep in mind that tariffs are mostly focused on goods, but still some of the inputs of services are based on goods, and therefore they are also a bit affected by the tariffs, but of course in much lesser scale than in manufacturing. But yeah, this is basically the landscape that they are looking at. Um, Now, for the ADP employment, this was a big one. Let me just close these out over here. That's no longer relevant. Yes, these are the jolts. We'll get to that. So here, private payrolls rose by just 22,000 in January, far short of expectations. Now, this keeps it also on the back that in December the figure was also revised down to 37,000. So in addition to having these yeah, worse than expected employment performance for the private sector, the December figures was also downward revised downward. So, and yeah, this is basically half of what was expected. If you look here, you'll see that for the most part, not been a surge, yes. Say, yeah, hiring is softening, continues a pattern which you noticed for the past 3 years. And so, outside of healthcare related jobs, the primary driver behind employment growth last year. So you see, it was not really something which is really added value to the economy. Financial activities added 40,000 positions, while construction rose by 9, and both trade, transportation, utilities, and leisure hospitality, yeah, only 4,000. So here, however, several sectors reported losses. Professional and business service stumbled 57,000, which is these are some of the most high added value adding in the economy. The other service lost 13,000. Manufacturing was down 8,000. Well, apparently the objective of bringing manufacturing jobs back to America is not going that well. Yeah, so all but 1,000 net jobs came from the service sector. Yes, so apparently this is a bleak picture of what's going on in terms of the private sector employment, and yeah, this is not nice. By the way, we had no employment data coming out on Friday. This was delayed to February 11th because of the shutdown, of the partial shutdown the government is going through. Um, Now, in terms of jobless claims, again, there was an increase, but still, we have here the news about the jolts, which is also a very important point here because it's about the job openings, and the job openings came quite a bit way below expectations and still below the previous month, and this was the fewest since 2020. Labor market remains sluggish, and yeah, basically this is about yeah, the number of people quitting their jobs, basically unchanged at 3.2 million. So even though we are still pretty much in a low fire environment, apparently this is becoming in a way bad because at this point it appears that layoffs are starting to increase, and the hiring continues to be rather subdued, and so yeah, this is not nice. Um, Now, the hiring recession is not going to end anytime soon. Just fell to lowest levels. a little hiring or interest in hiring expecting is happening in this economy. I understand this situation to some point, because with all the uncertainty about tariffs, about to what extent companies will be able to incorporate artificial intelligence into their activities, and so they want to play it safe. And until they get a more clear picture about what they are going to do about these two big variables that are looming over the job market, companies want to make sure that they make decisions with a more knowledgeable picture rather than doing these kind of decisions in the dark. So basically, this is what transpired in terms of information over the week. Again, next week we will have here on February 11th the employment report. This was not too bad, and this delay was not too bad, and the reason is because this was a week which had quite a lot events, volatility events into during this week, not counting with the earnings that we had, which by the way were somewhat also disappointing for investors. But also because it will spread out the volatility events more into across a bigger period of time, and because of that, options will remain with their premiums inflated for longer, and that of course benefits us because we'll be able to get more premiums out of the options that we sell. Now, we'll get to next week in a moment. Now, another picture that or another topic that I want to show is the fact that even though with of course as a result of all this information about the jobs not coming very good, the Fed futures predict or are now predicting a slightly less than a quarter probability of a rate cut in the next meeting in March. And why is that? Because basically the job market data came quite bad. But I think we'll have a better picture of what happened in January when the employment report next week comes out. Now, in terms of earnings, and this is also an important point to make, if we look at Alphabet, not earnings date, but we look here at the news. So this was something that investors did not like, and the reason they did not like, let's just try to do this NBC. All right, so this is basically what happened. They beat the earnings, but then what really made investors restless and punishing the shares is that apparently, even though the earnings were beaten, the revenue came out better than before. This is what spooked investors. Alphabet said that it would increase its 2026 capital expenditure between 175 and 185, more than double its 2025 spend. Now, investors now are paying a bit more attention to, instead of how much companies are investing in AI, but rather what kind of return they will be able to get out of this investment. The investors no longer want money being spent regardless at any cost, and so that's why when the earnings came out for Google, this was basically what happened. Let me check this works. Yeah, all right, so 1 week. And so here after the earnings came, and this was at the end of Wednesday, basically the market gapped down. Keep in mind that earnings were released after the market was closed on Wednesday, and the markets punished immediately this piece of news, even though the market then recovered somewhat, but then it ended up the week lower, uh, mainly because of this, even though the earnings were better than when what was expected. Now, Amazon, which also released its earnings, but on Thursday, let's look at here what happened. And yes, at the end of Thursday, as you can see, a huge gap, and not so much because of the investment or capital spending in AI, is rather because, and as you can see right here, let's see news. Yeah, let's see. Yeah, this is it. So the stock fall fell 8% because especially earnings were missed. Now, they did not miss the earnings by a long shot, all right? This is mostly this is mostly, let's see, so this is by billion. Yeah, so this is basically uh 20 billion. Not 20 billion. Yes, 20 billion. That's correct. And so oh, I'm sorry. Yeah, this is not correct. This is just 2 cents per share. Um, Even though the revenue was up and more than expected, the AWS web services had a better performance than expected, and the advertising also had a better performance than expected. But because the earnings per share were slightly below what was expected, this resulted in a large drop. And this again points to another sign which tells that valuations are stretched. Valuations are currently on the basis that revenues, profits will continue to grow at a very high pace. And when there is a stumble like this one, which is, I would say, relatively minor, the investors will punish the shares, yeah, heavily. And this is just what happened, as you can see, as soon as the earnings came out. Even though the revenue, which is probably the most important metric because it's less liable to be manipulated by one-time events, even though the revenue was a beat, and this is good. But yeah, this is the state of the market at this point. And there were other earnings, but I would focus just on these ones because these ones are the biggest market movers. And so yes, so with this out of the way, um, so the week, as I mentioned, was very volatile, and also, as I mentioned in the last video, we sold our calls for the Qs, for the IWM and the ARKK. All right, but as you recall, it was my intention to roll down the ARKK calls from 76.5 to 75.5, in case I would start to see that the strike price would not be reached. And this was exactly what I did on the 4th, as you can see here on Wednesday. However, and once again, like we tried to roll down on the IWM in the previous week, this happened at a very bad time because, and of course, this became even worse given the fact that the options are more illiquid, and that results in much larger changes in the prices that eventually made our strategy completely moot. And so, as I mentioned, we bought back these calls, and with the intention of selling the 75.5 ones. But as soon as I did this, the market started to come down heavily, and here you'll see, yeah, we tried to sell these, buy back these calls, and roll down for the other one, for the 75.5. But at this point, when we try to sell these ones, these calls for the same maturity were already below, with the bid price was already below the 70 cents that at which we bought these 76.5 ones. So as you can imagine, we were not going to be rolling down at a loss. The only way we could do this at a profit is to either wait for the stock to come back, and so that the calls would again gain some value. The 75.5 call would gain some value, so that then we can sell again at the profit. But it didn't happen. The stock continued to tumble, and so the only chance that we had was to roll over for the following week, for the February 13, with the 75.5 strike. So, and we received 68 cents on the share, so $204 overall, because these were 3 calls. So this is where we remain at the moment. The stock came down very heavily. There were days in which it tumbled 4% and plus. This was a very, very ugly situation for us here. It got to a point at which I think it went to close to 66 before recovering very strongly yesterday. Now, we cannot do anything about these calls at the moment. We'll just wait and see if we can sell them if the stock comes back to 75.5, which means we will break even. For the Qs and the IWM, again, we let them expire, because the stock, the calls were already close to worthless by Thursday, when the stock came down heavily. But yeah, this is the weekly graph. It was around here. It was already ready to be bought back and roll over. But if we roll over at this price around 600, it would not make much sense, because by rolling over we would get a very low premium on the calls. And so my hope is that, all right, the market may recover on Friday, and that will give us some chance to roll over the calls. But then, given the situation and the apparent volatility that we are going to have next week, here as you can see, with a lot of Fed speak, I think it made more sense. It seemed to make more sense to me that, all right, we'll just let this expire, and we will open new positions on Monday, next Monday, on the Qs and on IWM, which, by the way, ended up recovering strongly, but still below our 266 strike price. So we still kept the shares. Now, given the situation for next week, in which we have the biggest highlight, which is the U.S. employment report here on Wednesday, I have not checked yet checked the earnings for next week, but I think most of the stuff has already gone is already behind us. Let's see. It does not have any. Well, for some reason this is not helping. Next week. All right, now it is. Let's see. So I have no idea if this is fully accurate or not in terms of which companies are posting their earnings, but let's see. So on Monday we don't have much of it, apparently. Nothing that is really important for us. Yes, for Monday we don't have anything. For Tuesday, Coca-Cola, but this doesn't mean much to us. Most of the Magnificent Seven stocks has already posted their earnings. I think the only one that's remaining, which is the usual one, which is Nvidia, but Nvidia usually posts his earnings about a month later, a month after the other ones. So yeah, Robin Hood here. Um, Cloudflare, that's maybe important, but yeah. Let's see. No, I don't see anything in here. McDonald's, but yeah, Kraft Heinz, Blackstone, Shopify. Let's see, Core. Yeah, apparently. Yeah. Well, I think I'm not missing anything, but I don't see much of anything important in here. Unilever. Yeah. Apparently, most of the important market movers in terms of earnings is already behind us, and apparently now only the biggest one that will eventually come is Nvidia, Morningstar, but yeah, Coinbase. Yeah, given the fact that cryptocurrencies have been taking a beating, this may be interesting to watch. Coinbase, Expedia. Yeah, there is Mercer. No, all right. So yeah, and I'm sure that on Friday, Moderna. I'm sure that on Friday there must not be much. Yeah. So apparently there is no big market movers for the week in terms of earnings. I'm I'm assuming that I did not miss anything. So probably for IWM it may make sense because we are so close to the strike that we want. If continues like this by the time the market opens on Monday around 266, we will probably go ahead and sell just for the February 11th at the end of the day. Either at 266 or 267, we will have to wait and see. And the reason for that is because we want to capture the volatility of the employment report. After that, there is nothing in here. Oh, there is a CPI. Oh, this was, I'm completely mystified. I did not know that this was coming. But if this is coming, and then the decision is very, very clear. There is no point for us in doing anything else. We will just sell for the whole week. And in this case, we may sell either at 266, 267, even 268 probably. But for both for IWM and the Qs, there is no other. There is no. I don't think there is any better alternative. We will have to stretch our maturity for the options all the way until the, the end of the week. Of course, in the case of the Qs, the premiums will be small because we are quite a long way from the strike price that we want. But if the markets rise in the pre-market, this picture may improve somewhat, and so we will have to wait. But for the time being, we managed to collect for this week a little bit under 1700. We cannot account for this position on ARKK, these calls, because the position is not closed yet. We closed these IWM on the day of maturity. This was actually closed because we wanted to roll over the position to capture this premium from the IWM. But yeah, it was I don't think that we will be able to capture this amount of premiums next week because the Qs are so far down. hopefully, yeah, the picture will improve in early Monday. But for the time being, this is pretty much it. Feel free to leave your comments in the comment section down below. I'm also available on LinkedIn in case you need to ask me any questions. And as always, feel free to like the video and subscribe to the channel. And we will reconvene either on Monday morning or on Monday evening or Tuesday morning to start the week number 81 in this challenge. And I'll see you there.